Welcome, my viewers, and in today's episode we are going to look into factors that one should consider before uptaking an investment. Well, as we've been talking on this platform, we've been saying that one needs to have financial goals, and among many financial goals one can have, one of them is investing. And the reason one invests is to have a nice or a good or a successful financial future. You are able to take care of your expenses, you are able to add to your streams of income, you are able to build an investment portfolio, and that's why we are talking about factors to consider before investing. So there are many areas where one can invest, like you can invest in shares or stocks, you can invest in business, you can invest in government treasury bills and bonds and all these factors. And now we are going to look into those very factors that before you uptake this investment, one ought to look into, so that you make sure that the venture that you are getting into shall give you the returns that you're looking forward. It's worth noting that before I give you the factors, I want to put across some 4 points that are important before uptaking an investment. And one of these factors is that there is no investment that is 100% risk-free. You know, whatever investment you decide to take, you cannot be guaranteed 100% that there will be zero risk. But anyhow, you still need to go ahead and look onto all the factors that can affect the venture that you want to uptake. So no venture that is 100% risk-free, but you want to minimize the risk. The other thing is that you need to do all the due diligence before taking up this investment. You want to know where it is that you are investing and do all the due diligence before investing. The other point, the point to note is that you want to diversify your asset portfolio. And with this I mean, do not put all your eggs in one basket. Why do I say this? Should there appear, or should something happen to one of your investments, it will not affect your life. So you need to diversify your investments, like have more than 2 investments or a number of investments, such that should one investment is affected, the others are able to support you financially. And the last point that I want to put forward is that ensure the venture that you're going, or the organization or the business you want to uptake, it's legal and it's legally regulated, such that you do not put your money in some venture that should anything happens or it goes down, there is no way of following it up. So number 4 points to note. You know, these are not the factors, they are the points that I am giving that one ought to take note of before investing. That is, make sure, know that no investment is 100% risk-free. You know, mitigate your risk. Do not put all your eggs in one basket. The other one is that make sure that the entity that you are putting your investment into, it's legal. It's legal. So these are the points that I want to put across, that before uptaking any investment, you need to take into account. And number 1 point that I want to put across is that you need to know the reason for investing. You know, why are you, do you want to take up this investment? You know, it's clear that we do invest so that we do increase our income. We want to have a successful future that is financially stable. So that could be one of the goals, or many other reasons why one wants to uptake these investments. So while you know the reasons you want to invest, Maybe you want to invest for retirement. You want to invest or have this money such that when an emergency comes up, you have some money that you can use to cater for whatever emergencies come up. So if you saving or investing for your retirement, it means this investment, it is long term. It is not going to mature today or tomorrow. And if you're investing for an emergency, or you want to have an emergency fund that you're building, it means you need something that is short term, such that whenever you need this money, you are able to get it back. So while you know the reason why you're taking this investment, it allows you to know the kind of investment to take. For retirement, you take the one that is long term, and for emergencies, you take the one that is short term. So that's one of the main factors to consider. The other factor that one ought to consider is to conduct a market research. No one wants to invest their money in a venture that is going to go under immediately you put in your money. So you want to know the organization that you're deciding to invest your money in. How is it doing? Comparing with other similar organization in the same platform. How are they doing? So you want to conduct a market research. Know which area to invest in. If you want to invest in stocks, which kind of stocks do you want to invest in? Like, are they from the banking sector? Is it from the oil sector? Or what market do you want to invest in? So you want to conduct a market research. The other point that one must take into account is the rate of return. Anytime you're investing your money, you are putting it out there so that it can earn you a return, that your investment is going to grow in value, and whatever amount you have invested is going to grow to a higher value. So you want to consider this investment that you want to undertake. What is the rate of return do I expect from this venture? So by so doing, you are able to analyze, from many ventures, which one is giving me the best rate of return. So you want to consider the one that gives you best returns, and before you commit your money, you want to know that your money will yield you more return. And the other factor that one ought to consider is liquidity. You do not only want to take up this venture, you are promised this return, you are told that the market is doing well. You want to know, if I put in my 100,000, if I need this money back, or I need to liquidate this investment, how fast will I get back my money? This is a factor that one ought to consider, because you do not want only to invest knowing that you'll get back the money, but only to realize you cannot get back whatever you invested. You also want to know, if I want to liquidate, how many days will it take? What duration of time will it take before I process back my money? Or I want to liquidate, I have seen a better market, I want to sell off my share, I want to sell off whatever investment I have. You want to know how long it is going to take before I get back whatever I invested. The other point that one ought to consider is the company. This organization that you want to invest in, you want to know how it is doing. Because you do not want to invest in a venture that is not profitable, a venture that is not going anywhere. So there are factors that one needs to consider. Like, for example, you want to know what is the market share, the market that this organization commands. You want to know, how are they doing in their books of accounts? Are they making profits, or are they running in losses? You want to know that before you invest your money. You also want to know, who are the managers, who are the people leading this organization, what's their reputation, because if it's not well managed, even whatever money you're going to put in there, it won't be managed well. So you want to really do a background check on this organization, or if you want to start a business, you want to know how is such a business doing, similar businesses doing on the same platform, such that when you conduct a good background check, you know that this venture that I am uptaking, it will be a successful venture. The other thing that you want to know the risk, the levels of risk. Because anytime you are taking up this venture, you want to know, I am promised this rate of return. That's okay, I'm promised 20%, I'm promised 5%, I'm promised whatever rate. But you want to know how risky is this venture, because if you just uptake without knowing, you might end up losing whatever money you invested in the venture. So, and one thing that it's worth noting, mostly for the investment or ventures that are highly profitable, in most cases they are risky ventures, and you want to know what is your risk appetite, how much risk can you swallow, so it enables you to know the risk that you expect, and if it's, and you want to preserve whatever amount, the capital you invested, you need to know whether it is guaranteed or you have a risk of losing such money. For mostly, if it's low risk, low return, there's capital preservation. Whatever amount you invested is preserved. There is a guarantee that you are not going to lose that money. So according to your risk preference, the kind of venture to take: low risk, low return, or high risk, high return investment. So those are some of the things. And also the other one that you really want to know is the taxation. Each and every venture, you have a tax obligation that is attached to it. For example, for corporate, companies, they have a corporate tax at 30% of their net profit. For interest income, it attracts a 15% tax. For dividends, it attracts 5% tax, a tax on dividend. So whatever investment that you are uptaking, you want to really understand the amount of tax, or the percentage or the future obligations that are attached to this investment that you're taking, because you do not want to have trouble with the tax authorities, So those are some of the factors that one ought to consider before uptaking any investment. So those are a number of them, and I want to welcome you. If you have any other that you think could also go a long way, or we should add into this list, do not hesitate to put it in the comment section. And I want to put across that I am happy to always be here, and thank you for always coming to my platform, watching these educative clips, and I am appreciating the feedback. So you're welcome. Come, let's learn together. Come, let's eliminate some of these investment mistakes that one can end up making by learning and sharing with our friends and family. Thanks so much for watching. See you in the next episode.